Welcome back to Talk Tickers. This is the show for the experienced investor, where we strip away the noise, ignore the corporate fluff, and get straight to the numbers.
And I'm here to help you make sense of what those numbers actually mean.
So today, February 5th, 2026, we are diving into a company that's been just on a tear lately. We're talking Twist Bioscience. Ticker is TWST.
Yep.
They just dropped their Q1 fiscal 26 earnings, and the market reaction was, well, it was explosive.
It really was. And we need to set the scene here because this call happened pre-market February 2nd. The stock just immediately popped.
How much are we talking?
We saw shares up nearly 8% in the pre-market, sitting around $44-45.
Which is a big move, but those can fade fast.
Exactly. But what's really impressive is that it held. In this market, you see a lot of pop and drop, but Twist held a solid mid-single-digit gain, 5 to 8%, through the entire day.
And that's what gets my attention. It wasn't just a flash in the pan. But here's the hook for this deep dive. Why? Sure, it was a revenue beat, but this felt bigger. It felt like, I don't know, a narrative shift.
That's the perfect way to put it. This is Twist telling the market, we are not just a manufacturer anymore. They are actively and very loudly positioning themselves as the engine room for the entire AI bio revolution.
Yeah, it sounds like the market's finally listening.
For the first time in a while, it seems like they are really buying that story.
Okay, before we get swept up in all the AI hype, and trust me, we will get there, we have to eat our vegetables, the hard numbers. Let's do a quick snapshot of Q1 top line.
Record-breaking. Revenue hit $103.7 million.
Wow.
That's up 17% year over year.
Is that a $100 million mark? Is that just a psychological thing? Or does it really matter?
Oh, it absolutely matters, psychologically for sure. But for a growth company, breaking that quarterly barrier, it signals you've graduated. You're not a promising startup anymore. You're a real business on a 400 million plus annual run rate.
Right. It attracts a different class of investor.
A completely different class.
Okay, so revenue's up. But in this space, that usually comes with a pretty scary burn rate. What did the bottom line look like?
The GAAP net loss was 50 cents per share.
And compared to the street?
It was roughly in line, maybe a slight beat. But honestly, no one's buying Twist for the earnings per share right now. The real story, the number that had analysts buzzing, was gross margin.
The all-important metric. Where did they land?
52%.
52. Okay, put that in context for me. Why is that specific number so important?
It is a massive 400 basis point expansion year over year. You have to remember, at its core, this is still a manufacturing business.
Right, they make physical stuff.
For a company that makes physical things to cross that 50% gross margin line, that's the difference between being a commodity shop and being seen as a high-value tech platform. It proves the model scales.
And the balance sheet. Are they running on fumes or do they have cash?
They look pretty safe for now, sitting on about $198 million in cash and equivalents. So, a dilution event isn't an immediate concern.
Good. Okay, so financials are solid, but I want to break down the segments. You've got SynBio, NGS, Biopharma. Who was the MVP this quarter?
Oh, without a doubt, it was SynBio. That's the DNA synthesis and protein solutions group.
The growth engine.
It's the star of the show. Pulled in $51.1 million, up 27% year over year. That's where all the momentum is.
And SynBio, just to be clear, that's them writing the DNA. Right?
Yeah, correct. Building genes from scratch.
Okay, so what about NGS, next-gen sequencing? That's usually their bread and butter.
Right. NGS is for reading DNA. It's a more mature business. Revenue was solid, $52.6 million, but that's only up 8% year over year.
Only 8%. That feels a little soft.
It does on the surface, but there's a big caveat. They said if you exclude one single large customer fluctuation, basically a big order that didn't repeat in the same way, the underlying growth was actually 18%.
Ah, so the demand is still really healthy. It's just a bit lumpy.
Exactly. It's still the stable workhorse. And then you have biopharma services, which was up 39%. Smaller base, but growing fast.
Okay, so beat margin segments are growing, but the guidance is what usually kills a stock. Did they sandbag the outlook?
The exact opposite. They raised full year fiscal 26 revenue guidance. The new range is $435 to $440 million.
That's about 16% growth.
And this is the crucial part. They reiterated the holy grail target.
Let me guess. Profitability.
Adjusted EBITDA breakeven by Q4 of this fiscal year. They are planting the flag and saying the cash burn stops by the end of the year.
That is a bold promise when you're also talking about investing for growth. Usually you have to pick one.
It is. And that's what got the market so excited. It shows real discipline.
All right, I want to pivot back to that AI bio thing you mentioned. Every company is slapping AI on their slide deck now. Is it real or is it just buzzword bingo?
With Twist, I think it's actually structural. It's not just marketing. You have to think about how drug discovery is fundamentally changing.
Okay, walk us through it.
It used to be artisanal. A scientist with a pipette testing one idea at a time, super slow. Now it's all about an engineering cycle. Design, build, test, learn.
Design, build, test, learn. Got it.
So the design phase is where the AI lives. Customers use these massive models to design millions of potential drug candidates. But here's the problem. An AI can hallucinate a molecule that doesn't actually work.
Right. Just because the computer dreams it up doesn't mean it works in a human body.
Exactly. You have to validate the AI's homework. You have to physically build the molecules and test them. That's the build and test phase.
And that's where Twist comes in.
That is their sweet spot. They build the DNA, they build the proteins, they test them. And this is the interesting part. They are increasingly just sending the data back.
So the deliverable is a file, not a vial.
That's the phrase they used, DNA to data. They characterize the protein and send that data file back so the customer can make their AI model smarter. It's a flywheel.
Who are these customers, though? Is it just big pharma?
It's a mix. You have big pharma using them for overflow, but then you have this new breed, the dry lab tech companies.
Dry lab. Explain that. That sounds like an oxymoron.
It does, doesn't it? These are tech giants building biological LLMs. They have world-class algorithms, incredible compute power, but they have zero wet labs.
They can code, but they can't pipette.
Precisely. They are 100% reliant on a partner like Twist to do the physical side of the experiment.
So Twist is becoming the physical arm for Silicon Valley's bio ambitions. That's fascinating.
It's infrastructure. And the scale is what's just mind-blowing. They dropped a metric on the call. 50,000 genes manufactured for data characterization in 1 quarter.
50,000. Is that a lot?
It is a massive step up. A normal experiment might be 5 or 10 genes. 50,000 is industrial scale data generation. It's not a science project anymore, it's a data factory.
Did they put a dollar figure on it?
They did. They confirmed they've booked 25 million in AI-specific orders since 2025. This is real revenue, and it's turning into repeat production workflows.
And the mode is just speed.
It's all about speed. Twist can go from design to data in weeks. Traditional methods take months. You can't have your multi-billion-dollar AI model sitting idle waiting for training data.
Okay, demand side is exciting, but let's look at operations. CDO Emily LaProust talks about their NPI machine, new product introduction. What does that actually mean?
It means they launch new products like protein expression or these data services, but they all sit on top of the same core silicon chip infrastructure.
So they don't have to build a new factory every time.
Not at all. It's incredible leverage. And the CFO used this great analogy. He called their investment strategy a turbo on an engine.
I love a good car analogy. Break it down.
When you hit the gas on a turbo, there's a lag, right? You burn the fuel first, that's the spending, the hiring, and then a second later, the turbo kicks in and you get the acceleration. That's the revenue.
You know, they're telling us we're spending now, but the growth is coming.
Right. And it's a sharp contrast to the rest of the industry. Competitors are laying people off, cutting sales teams. Twist is hiring. They're playing offense.
That's a huge signal of confidence. But let's go back to those margins. 52% is the target floor.
It's the guidance floor. And here's the really interesting part on strategy. Management said they could be a $500 million business with 60% margins right now.
By just jacking up prices.
Basically, they could be more selective, price higher, grow slower, and be wildly profitable. But they aren't. They said they'd rather be a multi-billion-dollar business with 50% plus margins. They're choosing scale and market share over short-term profit maximization.
Which is the right long-term call, if you can pull it off. You need the math to work.
And here's the math. This is a stat for everyone to write down. 75 to 80% of every incremental dollar of revenue drops straight to the gross margin line.
Whoa. Say that in.
For every new dollar they bring in, 75 to 80 cents is pure gross profit. Their fixed costs are covered. It costs them almost nothing to add one more gene to the run.
That is software-level leverage in a hardware business.
It's why they can promise break even while hiring. As long as revenue grows, the bottom line fixes itself.
Yeah.
Fast.
Okay, let's zoom out. What does this all mean for an investor? How is the market seeing this now?
I think the pick and shovel story is finally solidifying. It doesn't matter if the winner is Pfizer or some dry lab startup. They all need the shovels. They all need the synthetic DNA.
The Levi strategy in the gold rush.
Exactly. And while the AI story is sexy, the NGS business provides that stable floor. And the market reaction holding that gain, it suggests investors finally believe the break-even promise. They're starting to decouple Twist from general biotech volatility.
I noticed that. I was looking at the charts. TWST is up, what, 45% in the last month?
Right. Now compare that to the XBI, the biotech ETF. It's up maybe 3%. The market is treating Twist like a high-growth tech platform, not just another risky biotech.
Which brings us to my favorite, most dangerous part of the show.
Oh boy, here we go.
It's time for our not financial advice segment.
And the disclaimer. We are just two analysts talking here. This is not financial advice. Do your own work. We are just spitballing an idea.
But if we were pitching an outrageous trade to an investment committee based on this call, what is it?
The trade is the synthetic sauce arbitrage.
Synthetic sauce arbitrage.
Okay, I'm intrigued. Explain it. The thesis is simple. The market still prices Twist like a manufacturing company with low multiples. But they're morphing into a data-as-a-service provider for the biggest AI models in the world.
So what's the play?
You go long TWST, and you go short the legacy CROs.
Short the contract research organizations, the traditional labs.
Think about it. CROs are slow, manual, human-powered wet labs. It's low margin and doesn't scale. If an AI model needs 50,000 proteins characterized, a traditional lab would need an army of people.
And humans make mistakes. And they're expensive.
But Twist's silicon chip doesn't get tired. The logic is you're buying the NVIDIA of biology while shorting the abacus makers. The volume from AI is going to crush the manual labs.
I like it. It's aggressive. What's the catalyst?
Watch for when they start breaking out data deliverables as a revenue line. The second the market realizes they're selling bits derived from biology, the multiple expansion could be violent. Tech multiples are way, way higher than manufacturing multiples.
The synthetic sauce arbitrage. You heard it here first. But seriously, don't bet the farm.
Please don't.
But looking at the reality of this quarter, it was impressive. Record revenue, exploding AI demand, and a clear line of sight to profitability.
They're proving that in this new gold rush, it really pays to sell the high-speed silicon-based shovels.
And on that note, we'll wrap up this edition of Talk Tickers. Thanks for tuning in. Do your own diligence, and we'll see you next quarter.
See you next time.